Earlier this week, the Fed released the results of its annual stress tests, and hopefully to the surprise of absolutely nobody, all six banks passed with flying colors. So now that we have some more details of each bank's capital distribution plans, be it through dividend increases and stock buybacks, and you're wondering, okay, what does this all mean for investors? Which one of these banks offers the most compelling opportunity for investors to get into? Then I recommend you stick around because I'll get into all that and more. And while this isn't financial advice, if you watch through to the end of this video, I'll be sharing where I'll personally be parking my capital into as well. For those who have not seen my videos yet, I go by 10 Bagger. I'm a self-made millionaire investor who specializes in buy and hold investing in great companies. And today I'm going to be talking about the financials, which is not something that I normally hold much of, but it's a core part of my cyclical portfolio. And I like them now, especially since we've seen a bit of a pullback in rates. And in terms of the overall value trade, right, how the S&P growth index has outperformed the value index, at least for a few weeks or so. And I remain quite confident that rates will be moving higher towards the end of the year. And if the Fed has to step in earlier to contain not just inflation, but a potential overheating of the economy, then banks are going to be by far your biggest beneficiary. I put together this quick Excel sheet to help us think about the dividend increases. So Morgan Stanley and Goldman are your biggest beneficiaries in terms of the dividend boost. You've got plus 100% for MS, 60% for Goldman. You also have a doubling of the dividend for Wells, but I consider them a bit differently since they're starting from such a low base. To round out the rest, plus 17% for Bank of America, plus 11% for JP Morgan, and last but certainly not least, 0% or higher for Citi. So Morgan Stanley was a bit of an outlier, and honestly, this was the one that I was most surprised by. Now, their dividend before was only 1.5, 1.6%, which was well below the peer group, so I was expecting a bump. I think analysts were predicting a 50% jump versus the 100% jump to 3.1%, or at the top of the peer group, which we actually saw. But I think there's two reasons for the bigger than expected jump. One is that the revenue mix at Morgan Stanley is changing. See, after the acquisitions of E-Trade and Eaton Vance, great acquisitions, by the way, a lot more of it is in more stable and consumer-oriented businesses, which would go to supporting a more sustainable dividend. Now, they have another $12 billion of buybacks on top of this dividend, which just goes to show how much of an embarrassment of riches they have going on. Now, does that mean that Morgan Stanley is more attractive as an investment? Sure it does, absolutely. But if we look at the run that the stock has had so far, basically it tripled since the COVID lows, and compare that to against its rival Goldman Sachs, I have a few observations. The first is that the market really likes the company's acquisitions and push into the consumer sector. These are seen as more stable revenue streams, more dependable compared to their institutional businesses. For that reason, the increase in stock price comes from not only earnings, but also multiple expansion. So if we look at Goldman, right, they're a lot cheaper on a multiples basis, but I think it's worth looking at not only where they are, but where they're headed. For one, Goldman just has way more trading and investment banking firepower, more so in trading, definitely, than Morgan Stanley. It's not because I worked at one or the other and I'm some kind of alumni fanboy. That's just a fact. Goldman is capable of posting these wild EPS beats of 80%, 60% quarter after quarter, which is a lot higher than what you'd expect out of Morgan Stanley. So if we normalize these results for the increased predictability of their performance and just acknowledge that these analysts have historically done a poor job of forecasting some of the catastrophic, these wild beats, then Goldman looks a lot cheaper. How much cheaper, you might ask? Well, for comparisons purposes, I've taken in this Excel sheet the analyst estimates for 2021, fiscal 2021, and then next to that, I've annualized my estimate of 2021, which is very quick, very unscientific. It's just taking first quarter 2021 actuals, multiplying that by 4 to get a rough estimate of the upper bound that we would expect, given that Q1 is typically a stronger quarter for the financials, to get a range of what that multiple could be, right? So the 2021 analyst estimate is definitely too low. My multiple could be too high, it might not be, but on the range, it just shows that Goldman is half the valuation of where Morgan Stanley is just on an earnings perspective, without taking into account any potential multiple expansion by Goldman in the future. But it's also worth remembering that the revenue mix at Goldman is also changing, right? Goldman is getting into a lot of the consumer businesses that Morgan Stanley is already in, such as bank accounts, RIAs, credit cards, transaction banking, and wealth management, just to name a few. They know they're behind that 8 ball versus their rival, but they also realize now that after seeing what the market is willing to pay for consumer versus institutional businesses, they're executing aggressively on that playbook. We see that when John Waldron goes on stage and talks about the firm-wide strategic priorities, and I believe that they're on a path with some of their acquisitions, with some of their signaling, that they are transforming Goldman to be more of a consumer-centric enterprise. So with Goldman, I see a great mix of actually value here and a nice growth runway from both earnings surprises, which I do think they'll continue to do, as well as multiple expansion from getting into these more lucrative sectors. So between Goldman and Morgan, I would pick Goldman any day, as I expect them to catch up to where, Morgan Stanley's price was for most of 2020. For some of the other banks, look, I think it's a relatively muted affair. JP Morgan increased its dividend by 10 cents a share, or just 11%, which I know isn't crazy. But the bank already had a pretty decent payout ratio to begin with, and after this 11% raise, it still puts them on the upper half of banks. And previously, they also announced 30 billion worth of buybacks, or roughly equal to about a year's worth of net income. And that's where the real money is, in my opinion. See, Jamie Dimon and the guys at JP Morgan, they like buybacks over dividends, which is fine by me. Does that mean I like the stock? Yeah, but just not as much as the others. It's still the most expensive on basically every conceivable multiple, has had a big run, and in my opinion just doesn't have the sort of catalyst that some of the other banks do. Bank of America is another one of those what I would call in-line to maybe even below in-line performers. Was it a bigger raise than JP Morgan on a percentage basis, 17% versus 11%? Yeah, absolutely. But the yield was much lower to begin with. So now that they're barely getting above that 2% mark, I consider that to be sort of table stakes. So I have to ask, what happens when the bank's share price advances, let's say 10%, 20%, 25%, and then suddenly that yield falls from 2% to 1.75% to 1.5%? Then what happens, right? Are they going to have to raise the dividend? And if they do, are they going to raise it back up to measly just above 2%? I think that's the question that you have to ask if you're a dividend investor. In my opinion, they're just not sending a clear enough signal to the market that they really value the dividend. Sure, it's important to remember that they have 25 billion worth of buybacks that they can tap into. So from a total return perspective, if you're owning Bank of America, you'll probably be okay. But if you're owning the stock primarily for the dividend, then my suggestion is you probably want to look elsewhere. Now, Citi. Look, I really didn't expect too much from Citi, right? Their dividend was already at a decent level relative to its share price, but the fact that they issued no statement at all with respect to the dividend was kind of a disappointment, if I'm being honest. It seems like they've always been the bearer of bad news. The CFO cautioned about consumer results, and while all the other banks, even asset cap constrained Wells, is posting solid results, it's making me question, why? Why doesn't Citi have its house in order? And there's something that I just don't understand about the bank, which makes me a little bit hesitant, but it's still by far the cheapest bank. And with the new CEO at the helm, I'm willing to give them a few shares and a chance. But from a signaling perspective, I get it. The company is under a lot of regulatory scrutiny over its risk controls. So signaling a big capital outlay in definitive terms might anger regulators. Fine. Show, don't tell. Prove, right, that you can pay us a bigger buyback, do it quietly behind the scenes, but don't tell us. Fine. Not what I want to hear, but I get it. Okay, last but not least, Wells is really interesting. See, I was looking for a dividend hike of about 25 cents per share, or a dividend to 25 cents and 10 billion of buybacks, but it looks like we got slightly less on the dividend and a little bit more on the buybacks. And I'm honestly okay with that. See, with Wells, you have to remember that appeasing the regulators is far and away their number one priority, right? Everything else has to come second. So if Charlie had good reason to think that not committing to firm numbers on the dividend and buybacks would speed up the lifting of the asset cap, then that is a wise decision. The optics here matter a whole lot. But guys, I'm pretty happy with the 20-cent dividend and 18 billion of buybacks in this environment. I think Wells continues to have the greatest number of catalysts in its arsenal, is most exposed to a vibrant reopening economy and rates increase. And for that reason, it's going to be one of my top picks along with Goldman. I have a more detailed video up here that breaks down a lot of my thinking, and I just don't want to bore some of my repeat viewers. But if you're interested, please check that out. Now, guys, The last part of the video, I'm going to touch on buybacks and why I think investors ought to pay more attention to some of these numbers being thrown out. See, with dividends, they carry a powerful signaling effect. You never want to be caught in a position where you may possibly have to cut the dividend at any point in the future. Dividends are meant to be raised over time, and they represent this sort of low water mark that you know you can hit quarter over quarter without even thinking about. So in a booming economy or pro-cyclical environment, such as the one that we're in, where we get this like bumper crop versus a sustained increase in performance, I think it's more conducive to increasing in buybacks versus dividends, because you never know when in the future the market might correct or the economy might contract. The Delta variant might prove more virulent than expected. People might not get vaccines as readily as we hope. There's a lot of things that can go wrong, which is why I think buybacks, which are more temporary in nature, are actually a very good thing. And unless you're an income investor or a retiree, you ought to probably be more concerned about the total amount of capital distributions rather than what form they take. See, for a lot of the banks, especially those that trade below fair value, such as Wells, such as Citi, I actually think that the bigger emphasis on buybacks is actually a really big positive. See, management and the board know that their stock is trading like garbage, and buybacks can help lift this. They create value when they're done at a price below the company's intrinsic value. Now, the second important piece that I want to throw out there is that if we look at the magnitude of these buyback programs, they're absolutely massive. Across the board, they're equal to at least a whole year or even more's worth of net income. So these are pretty large, chunky distributions, to say the least. So if a company is able to buy back, let's say 10 or 15% of its stock, then its share price should naturally rise by that amount, 10 to 15%. And if we look at the size of these buyback programs relative to how much they can lift the stock, Goldman and Wells take the top two spots at 10 and 15%. Now, this is kind of like the cherry on top, right? I like these two stocks the best for other very solid reasons, but this just makes the case all the more compelling, right? So guys, what do you think? What are you holding in the aftermath of these stress tests and the capital distributions? Let me know in the comments below. Thanks for watching. As always, nothing is more valuable than your time, except for maybe your money. And if you liked my analysis, please consider giving this video a thumbs up and subscribing, and I'll catch you on the next one. Peace.